Masterclass lesson 13, the relative strength index, or the RSI. So the RSI, the relative strength index, looks like this. It is used to measure the speed and change of price movements. It measures the strength of its trend direction up, down, and sideways on any market by monitoring the changes in its closing price. So what's important to note about the RSI, and we're now talking about the anatomy, is that it is a closed oscillator. It has a limit between 0 and 100, and then stops between 70 and 100. We say that it is overbought, where the market is at a certain price beyond high. The buyers are going to start fading out. So the market moves up, there's buying and the demand is increasing. And then when it gets to the point where there's been so much buying, it forms a little bubble. So it forms a little bubble, and at the overbought levels, we can expect the price to then start dropping and for the sellers to start kicking in, which will drop the price. Between 70 and 100 is overbought, where there is a lot of supply and a lot of buyers that have bought into the market, and now the sellers want to take over. Then you have the oversold level, which is between 30 and 0, where you have the market that has been selling and the price has been going down. And now at a certain level, the buyers are going to say, hold on, the market is now quite low, and we are going to start buying the market to push it back up. So the overbought zone is where the X is above 70, and this gives a selling opportunity in a trending market that's moving up. And the oversold, which is the X is less than 30, is a buy opportunity for where the market has been coming down. All right. Notice I use the word trending market. Then we have the market environment, which is also very important. Now, the way I see it with RSI, not everyone sees it this way, but I like to use the 50 level of the RSI to determine whether the market is in a bullish momentum or in a bearish momentum. Between 50 and 100, when the RSI crosses above 50, it is in a bullish territory. This is where the buys are kicking in. Then you have between 0 and 50, where I like to call it a bearish territory, where the sellers are still dominating the market and the price is more likely to continue down, or it is in a downtrend. In a trending momentum market, not sideways. Sideways, these indicators are null and void. I tell you that much. They do not work in sideways markets. So the 50 mark is the neutral zone that you can determine where the price you wanted to break up for going into a bullish territory for the price to move up, or break below the 50 to enter into a bearish territory. So now let's talk about divergences, which is probably the most important element to RSI when trading a market. So the first thing, the two divergences that we're talking about is a bearish divergence and a bullish divergence. A bearish divergence is where the price of the market is moving up and the RSI momentum is moving down. The buying that is taking place within the price is not as strong and convincing, and therefore you can expect the price to drop. So this is what happens. The price moves up and the RSI drops. And how you use this is because you're using the resistance or the ceiling level, where they are making lower high prices. And when it makes lower high prices, well, the price is making higher lows, then saying that the momentum of the RSI is showing bearish divergence, where the price is now more likely to move down and break down, which it exactly did at this point. The RSI in this case formed a bullish divergence, and a bullish divergence is where it started forming higher low prices. Okay, so it formed higher low prices. Well, the market was making lower highs. Now this is known as a bullish divergence, where the price is coming down and the RSI momentum is going up, and this is an indication that the price is more likely to move up. We have the RSI indicator at the bottom and we have a price at the top. Where is the lowest low and what is the next low? This momentum is showing that the RSI is moving up in momentum. Then let's see what is going on here. So at this point, there's a low price, and at this point, there is a high low. So what you can say is that there is a confirmation divergence, that there is bullishness in the market. So when the price of the RSI is moving up and the price of the market is moving up, there is a high chance that the momentum will continue, which is exactly what it did and looks good. When the price broke above the 50 mark, the upward momentum continued. And when the price broke below the 50 mark, the downward momentum continued. And now at this level, we can say that the market is overbought, but you do want to follow the trend and have other indicators in the background to help you confirm of where the market is more likely to go.